Okay, so when you think about retirement planning, what comes to mind? Probably 401ks, IRAs, the usual suspects, right? But what if I told you there's another tool, one that's been hiding in plain sight that just got a massive, massive upgrade? Well, today we are putting the health savings account center stage. Welcome to your HSA Masterclass. So let me just start by asking you this. Is it possible your health plan is hiding a supercharged retirement account? I know, it sounds a little crazy. Most of us think of an HSA as just a little side fund to pay for prescriptions or a trip to the doctor. But it is so, so much more than that. It is genuinely one of the most powerful tax-advantaged retirement vehicles you can get your hands on. And thanks to some brand new legislation, its potential has been completely unleashed. So here's how we're going to break it all down today. First, we'll uncover what I like to call the secret retirement account. Then we'll get into the good stuff, the big, beautiful upgrade that just changed everything. From there, we'll build your retirement playbook with actionable steps, kick it up a notch with the HSA Masterclass for pro-level moves, and finally, we'll talk about planning your legacy. All right, first up, the secret retirement account. Because before we can really appreciate these new upgrades, we have to understand the incredible power that was already baked right into the HSA from the very beginning. So let's start with the basics. What exactly is a health savings account, or HSA? Well, the textbook definition is a tax-advantaged savings account for healthcare expenses. And there's one main entry ticket. You have to be enrolled in a qualified high-deductible health plan. Simple enough. But that little phrase, tax-advantaged, well, that's where all the magic happens. And this right here, this is the HSA's superpower. It's something no other retirement account can claim. The unbeatable triple tax advantage. Think about it. 1, the money you put in is tax deductible, which lowers your tax bill right now. 2, that money can be invested and grows completely tax deferred. And 3, when you pull it out for qualified medical expenses, it's 100% tax-free. A tax break on the way in, a tax break while it grows, and a tax break on the way out. It is truly in a league of its own. So why is this such a big deal? Well, as Stephen Feinschreiber over at Fidelity puts it, healthcare will likely be one of your top 5 expenses in retirement. We're not talking about a small, predictable cost here. This is a huge financial hurdle that pretty much all of us are going to face. So having a dedicated, tax-free bucket of money for it, that's not just smart, it's absolutely essential. And just to put a number on that challenge, take a look at this. Fidelity estimates that a 65-year-old retiring in 2025 could need a staggering $172,500 in after-tax dollars just for healthcare. Now, if you pulled that from a 401k, you'd actually have to withdraw a lot more to cover the taxes. But with an HSA, that money comes out clean, no tax bill attached. That's a huge difference. Okay, section 2, a big, beautiful upgrade. Now that we're all on the same page about the HSA's core power, let's talk about the new legislation that just strapped a rocket to it. A recent bill has completely changed the game, and these changes are set to take effect in 2026. This table really breaks down the 3 biggest changes. Let's look at the before and after. First, and this is a huge one, eligibility. It used to be that only these very specific IRS-defined health plans qualified. Well, starting in 2026, all bronze and catastrophic plans on the public health insurance marketplace will be eligible. That opens the door for millions of people. Second, telehealth. That convenient pre-deductible coverage is now permanent. And finally, direct primary care. This cool model where you pay a monthly fee to your doctor, that used to disqualify you. Now, not only is it allowed, but those fees can be paid for with your HSA. So what's the bottom line for you? It means millions more of us can now open an HSA. It means you can use telehealth without worrying if it's going to disqualify you from contributing. It means you can combine the amazing tax advantages of an HSA with an innovative healthcare model like direct primary care. And, oh, by the way, the bill also tucked in a nice little bonus for families, permanently boosting the dependent care FSA limit up to $7,500. And for anyone who's curious about that direct primary care option, the law got very specific with the numbers. Starting in 2026, you'll be able to use your HSA to pay for DPC membership fees up to $150 a month for yourself or $300 a month for your family. This is a really big deal because it officially integrates this modern way of getting healthcare into the tax-advantaged world of the HSA. All right, we've got the fundamentals, we've got the new rules. Now for the really fun part, Section 3, your retirement playbook. Let's get practical and talk about how you can actually use these strategies to build a more secure financial future. Okay, these are the numbers you're going to want to know for 2026. The maximum you can contribute is $4,400 if you're single and a whopping $8,750 for a family. Now, if you're 55 or older, you get to add an extra $1,000. And here's a little pro tip. If both you and your spouse are over 55 and have family coverage, you can each add that $1,000 catch-up, but you have to put it in separate HSA accounts. That's an extra $2,000 a year. The numbers on the bottom just show you what kind of plan you need to have to be eligible. This right here is why the HSA is such a rock star in retirement. The flexibility is just incredible. Let's say you retire early, before you're 65. You can use your HSA to pay for health insurance premiums to bridge that gap to Medicare. Once you're on Medicare, you can use it to pay for your Part B and Part D premiums, tax-free. It can even cover premiums for long-term care insurance. And then there's the ultimate backstop. After you turn 65, that penalty for non-medical withdrawals just disappears. It basically turns into a traditional IRA. You can pull money out for a vacation, a new car, whatever you want, and you'll just pay regular income tax on it. Amazing, right?
All right, you've got the playbook, you know the basic moves, now it's time to level up. Welcome to Section 4, the HSA Masterclass. These are the pro-level strategies that can turn your HSA from just a simple savings account into a powerful wealth-building machine.
Okay, buckle up because this is one of the coolest and most powerful HSA strategies out there. It's often called the shoebox method. See, the IRS says you can reimburse yourself for a medical expense, but they never say when. So just follow this timeline. In 2026, you open your HSA and start funding it. You get a $200 medical bill. Instead of using your HSA, you pay it out of your checking account, and you just save the receipt, digitally, of course. Now, fast forward 10 years. Your HSA has been invested and has grown quite a bit. You have a $1,000 medical procedure. Same deal, pay out of pocket, save the receipt. Now, let's jump to 2046. You're 70, you're retired, and maybe you want $50,000 for a big trip. You can literally gather up 20 years' worth of those receipts you've been saving, and you can withdraw $50,000 from your HSA, completely 100% tax-free. You've basically created your own private, tax-free emergency fund that's been growing for decades. That new legislation also snuck in another pretty powerful benefit for retirees. It's called the senior bonus deduction. It's a temporary deduction of $6,000 per person for those 65 and older. So for a married couple, that's a $12,000 deduction. But there's a catch. It's designed for middle-income folks, so it starts to phase out as your income gets higher. For couples, that phase-out starts at an income of $150,000. And this is where your HSA becomes a secret weapon for tax planning. So check this out. Let's imagine a retired couple. Their base income is $130,000, and they need an extra $30,000 for whatever reason. Now, if they pull that from their traditional IRA, their income jumps up to $160,000. That's over the limit, so poof, that $12,000 deduction is gone. But what if they use that shoebox strategy we just talked about and reimburse themselves $30,000 from their HSA? Well, that withdrawal is tax-free, so their income stays at $130,000, they get the cash they need, and they get to claim the full $12,000 deduction. That's a massive difference. Here's another pro move: avoiding the dreaded IRMA. That stands for Income-Related Monthly Adjustment Amount. It's basically a fancy way of saying if your income is too high in retirement, you're going to pay a surcharge on your Medicare premiums. So in this scenario, we have a couple with a base income of $210,000, and they need $20,000 for medical bills. If they pull it from their IRA, their income hits $230,000, which pushes them over the threshold and triggers a costly surcharge. But if they take that money from their HSA as a qualified withdrawal, it's tax-free. Their income stays at $210,000. They stay safely under the line and avoid the surcharge completely. This is strategic retirement planning at its absolute best.
And that brings us to our final and really important section today: planning your legacy. It's something we don't always like to think about, but what happens to all that money you've saved in your HSA when you're gone? It's a critical part of the plan.
First, I have to point out one more key advantage that really sets the HSA apart from a 401k or traditional IRA, and that is there are no required minimum distributions or RMDs during your lifetime. With other accounts, the government eventually forces you to start taking money out. Not with an HSA. You are never forced to touch it, which allows that account to just keep growing, tax-deferred for your entire life. It's a fantastic tool for preserving and passing on wealth. Now, this is where it gets really, really important. Who you name as your beneficiary makes a world of difference because the rules are night and day. If you name your spouse, it's a beautiful, seamless transition. The account just transfers to them and it stays in HSA, keeping that incredible triple tax advantage status. But if you name a non-spouse beneficiary, like one of your kids, the second you pass away,
that account ceases to be an HSA. The entire value of the account becomes taxable income to your child, all in a single year. That can create a massive unexpected tax bomb. So getting this beneficiary designation right is absolutely essential. This new legislation didn't just tweak a few things. It fundamentally changed the landscape of retirement planning. The HSA is no longer just a small account you use for copays. It's a dynamic, strategic tool for managing your income, slashing your taxes, and building a lasting legacy. So the rules of the game have changed. The real question is, how will you change your plan?